Hi there everyone, welcome to this interview. We've got David Le Breton from Hobson Wealth with us today, and we are going to talk about investments. David, welcome. Can you please introduce yourself and tell us a bit about yourself?
Sure, thanks for having me, Patrick. So I'm an investment advisor for Hobson Wealth. I've been with Hobson for the past 2 years. Prior to that, I was a wealth manager for ASB. I moved down to Tauranga in 2014 with my wife and my 2 children. Come here for the better lifestyle. So I've spent since the last 6 or 7 years advising my clients on the right investment strategies for their needs. Yeah. And if I'm not doing that, I'm usually trying to catch a fish or 2 on the boat or coaching my son's cricket team.
All right, oh cool. Yeah, good lifestyle here in the Bay.
Fantastic, all right.
Yeah. So, what's the difference actually between Hobson Wealth and the bank?
Probably quite a few differences, Patrick. So as people appreciate, the ASB, along with the other banks, very large organisations, Australian owned, and catering to a wide range of people's needs. So, the investment side of it, lending, insurance, credit cards, banking, you name it. Hobson Wealth, on the other hand, we are predominantly New Zealand owned, over 90% of the business owned by the employees and advisors. And we are primarily focused on wealth. In fact, that's all we do is help our clients invest their money and meet their investment needs.
Yeah, awesome, okay. And so if I was to invest my, my wealth, what is on average the return that I could expect?
Well, of course it varies, as you'd appreciate. No one house generates the same return as another. For our clients, their strategies are typically quite different and will generate varying returns depending on how much is in property or shares versus what they've got in cash and fixed interest. But if you look at the past returns, they've been similar to what property has generated, and in some cases higher.
Yeah, yeah. Oh, okay. And so, because what we see in property, that on average, it's about 5% of the return that property investors get. However, you still got the insurance and the rates, maintenance, property management, all those costs that we need to deduct from it. So the net return will be around the 3%. How does that stack up with the share market?
Well, Patrick, shares, particularly in New Zealand and Australia, tend to generate dividends in a similar ballpark to what a rental property would generate. I guess a key difference and arguably a benefit though would be that the costs that you deduct from those dividends are pretty well known ahead of time. So sure, you've got some tax that's going to come out of there, and you might have some costs around paying for advice and some transaction costs there. But unlike property, you rattled off some of those costs, but they can always be more than what people anticipate, and there's often costs that you just wouldn't even think about that come in as well.
Yeah, so it is with investing in shares, the cost up front. Is that what you're saying?
Yeah, well, you've got, you've typically got, tax and fees that you might be paying for having that investment managed, or your advice, and so those are known up front. Certainly at Hobson Wealth, we don't want to give our clients any surprises. Yeah. Yeah, that's somewhat different to perhaps investing in property, isn't it?
Yeah, definitely. Yeah, because the hot water cylinder might break.
I don't know about you, but I've certainly had that happen in the past.
Cool. So again, looking at property, we see that the capital gains per annum is about 5%. We've seen it a bit better in the last 2 years. But yeah, again, how does that stack up with the share market, or investing in funds? Is there capital gains in there as well?
Yes, there are. So in the share market, just like in property, people are investing to get a mixture of returns. So we've talked about the income, typically comes in the form of a dividend, but people are also investing in shares to get some capital growth over time. So you buy shares at a particular price, or you buy a managed fund at a particular price, and over time that price is going to change, and we expect over time it will go up as the value of those companies and the profits they generate rise. So if we look at how that's performed in the past, you can take a snapshot of the last sort of 6 months, and we've seen the share market bounce back strongly, around 30% return over 6 months. But if you go back further, the last 10 years have delivered roughly about 10% a year. And in fact, the long run average for the share market sits at around 9% a year, very similar to what property has done over similar timeframes.
Yeah. So David, it seems to me that for a younger person, it might be better to invest in property, but then when they grow older, it might be better to change that approach, sell up and invest in a fund. Is that correct?
I think there's certainly merit to that approach, Patrick. What we are seeing though, and certainly this year, there's been a rise of younger people investing into the share market, investing into managed funds. But the advantage that property offers younger people over those other investments is leverage. The fact that you can take your deposit and go to the bank and borrow up to 80 or 90% and buy a property means that over a long run you're able to magnify your investing power and create wealth that, as you say, when you retire, you've then hopefully got a nice big nest egg that you can come to someone like me and we can develop a retirement strategy for you to take care of of your goals without the hassle of tenants and hot water cylinders breaking and that sort of thing.
Yeah, cool. Because it's also that you can invest in property, but you basically what you do is you put all your eggs in one basket. Is that right?
Well, you are. If you think about how much your house costs or a rental property, it's a lot of money tied up in one asset in one particular location. So we advocate that people should have a mix of assets. So if you're going to have property, we think you should have lots of properties and not just residential. You might have industrial and commercial, and then you look at that and go, well, how do I do that with the amount of money I have? And that's where we use the likes of listed property investments that people can access a wide variety of investments in different properties. But property is just one asset we think people should have. We've touched on shares being the second asset people should have. So property and shares will give people growth over the long run and some of that income we've talked about. And people with a high risk tolerance and long investment time frame might have lots of shares and property in their portfolio. But then for people that perhaps are a bit more risk averse, don't have as long a time frame for investing, they should have some cash and fixed income in their portfolio as well. Those are the assets that are more stable, less likely to go down when things aren't going so well in the economy. And so what we do is put all four of those different asset types into a portfolio based on the client's risk tolerance and what they're trying to achieve.
Yeah, okay. All right, that makes sense, because I think as a retiree, I could be a bit worried to sell up the properties that I've got, because brick and mortar, you can touch it, it's physical, and then put it into a fund. So how do I overcome that fear of changing my strategy?
I think it's really important to deal with someone that you can have a really good trusted relationship with. Deal with a firm like Hobson Wealth that's got a very long track record of helping people achieve their investment goals. But importantly, it's about having a discussion and understanding, well, what's the point of having those properties? What are you trying to achieve behind that? And of course, it's not all plain sailing with property, is it? Many people that have invested in property over a long period of time will have those examples where their investments went down or it went bad because of a tenant or some other reason. So, and look, Patrick, when I see clients and we're talking about their retirement needs, it's often about benefiting from the wealth they've created, being able to go overseas and travel, enjoy the time with the grandkids and do all other things that their money allows them to do, rather than worrying about what their money or their properties are actually doing. So we give people peace of mind in that sense. Yeah. And also they've got someone they can talk to and understand what's going on and complain to if they're not happy with the return they're getting.
All right, so what we've learned today, or what I've learned today, is that in the stock market, the share market, funds, the income is actually similar as to investing in property. Right? But also, to not have all your eggs in that one basket of just property, especially not when you're at a retirement age, but have that conversation with a trusted advisor like yourself, and and have a bit of a strategy in regards to selling up with a good real estate agent like myself, hopefully. But then, have that strategy and move on from there to have that better lifestyle as a retired individual. Is that correct?
Yeah, Patrick, I think it's having that plan which is really key. You know, understanding what people are trying to do by investing in property, or if they're going to sell up and liquidate, you know, what are they trying to achieve by that? And so we can sit down with them, understand their goals, and their situation. What does the future look like, or what would they like it to look like? And we'll put a plan together and develop an investment strategy for them.
Yeah, awesome. Thanks very much.
Pleasure, thank you.
And thank you for watching.